Hi everyone, welcome to the channel. This is your Govindraj. Thank you very much for watching my all previous videos and your subscriptions. And in this discussion, we are going to talk about the recent guidelines of Employees Provident Fund Organization on tax on employees contribution. See, after having read these 43 pages of these EPFO guidelines on interest on PF employees contribution, my conclusion is that you have to be an accountant, legal, and also tax expert to understand these guidelines, because there are a lot of complexities involved in it and there are a lot of purpose behind it. And you also need to know the relevant provisions of Employees Provident Fund and Miscellaneous Provisions Act 1952 and the Finance Act 2021 and the Income Tax Act 1961, Income Tax Rules 1962, and in addition to that you should also know certain specific provisions of EPF scheme, which is Employees Provident Fund Scheme 1952. And I have read, of course, and understood what is necessary from the employees and employers point of view. And if you look to my channel in the previous videos, there is already one video on tax on provident fund and its interest, know why and how. You can watch this video, and I have already explained the provisions of Finance Act 2021, Income Tax Act 1961 and Rules 1962, especially explaining the interest on employees provident fund contribution. And of course, now let me take you through briefly these EPFO guidelines on calculation of interest and also how they arrive TDS on employees contribution exceeding 2.5 lakhs per annum. If I have to give you a little brief, the Finance Act 2021 actually inserted two provisos to section 1012 of Income Tax Act 1961, because this excludes certain payments from the provident fund from the exclusions they provided under this section. And of course, this will take effect in the financial year 2021 and 22, that is 1st April 2021. And rules on how to calculate and how to make taxable account and how to make non-taxable account are actually notified by the central government on 31st August 2021. And Rule 90 is also inserted into IT Rules 1962 to give effect to the first proviso of section 1012. And recently, as I said already, the EPFO came up with detailed guidelines via their circular dated 5/4/2022, and these guidelines specifically talks about the interest calculation in both taxable and non-taxable account, and also how the taxable account is treated for TDS deduction. And of course, this is a 43-page guidelines. I am not able to explain to you in this 10-15 minutes video, but in the nutshell, let me take you through the key understandings. See, if you look at these guidelines and also relate back to the Finance Act 2021 and also certain income tax provisions, see, the employee contributions which include voluntary provident fund which exceeds 2.5 lakhs, that accumulations will be placed in an account called taxable account. This is effective from 1/4/2021, and the interest on this excess amount, which then again gets calculated and separately and also is treated for TDS deduction. But the good news is that the EPF accumulations up to 31/3/2021 and also the interest on these accumulations, and in addition to that, contributions up to 2.5 lakhs from 1/4/2021 and also the interest on up to 2.5 lakhs which gets calculated and also placed in non-taxable account, these are free from the tax. So this is good news, and of course this gets maintained separately from 1/4/2021. And the TDS rate, for example, on the taxable account, depending on the status of the individual member, because this TDS depends on certain specifications and whether your PAN is linked or not linked. So however, if you are a resident as per income tax rules and your PAN is linked to your UAN, which is your provident fund account, and in that case the EPFO deducts 10% of the interest in the taxable account as TDS. And of course the EPFO is obligated to provide you form 16A on or before 15th June every year, subject to certain changes in the timelines. And another important thing you should remember is the PPFO actually deducts tax as per section 194A of the Income Tax Act, and the total interest actually is to be treated as income from other sources in your IT returns. And because of this, your liability may be higher than what the EPFO deducts, at least 10% or 20%, depending on your tax slab. See, based on your total income, you may be in a different tax slabs. So therefore, if you don't take care of the tax payments within the limits, then your liability for interest and other expenses may go up. So therefore it is the responsibility also of you to intimate this taxable interest to your employer to make sure that the tax is deducted properly and you already cover these taxes in your annual income and TDS deduction. And of course your employer is also required to facilitate you in this process. See, another thing is important that the opening balance for the year 2022 will also be arrived after deducting the TDS in the taxable account, and this again earns interest in the taxable account in addition to the fresh contributions and fresh interest. So that means it is on a cumulative basis. The moment the taxable amount and the interests are placed effective from 1/4/2022, then that also earns interest, and that is again liable for tax in the succeeding years. And let's see how the EPFO calculates interest on the running balance. See, if you look at this illustration given by the Provident Fund department, so they have treated that an employee 30,000 rupees every month, and if you look at this statement, up to 2.5 lakhs, the taxable account has no role to pay, whereas both the contributions and interest are placed in the non-taxable account. The moment your contributions exceeds 2.5 lakhs, then whatever exceeds comes into taxable account, and interest which also gets earned on this taxable amount will also be placed in the taxable account. So you can see from December 2021 to March 2022, where in this period your accumulation actually have exceeded from 2.5 lakhs, and the excess money is actually placed in the taxable account, and the interest is also calculated. See how the PF department calculates the interest on your accumulations is basically on running balance. For example, if you have 30,000 at the end of the month, then you calculate 8.1% on this running balance, which is in this example in the January-April month it is 30,000 into 8.1% divided by 12, it will give you 203. And also in December 2021 you can also calculate the interest on taxable account, which is 20,000 rupees into 8.1%, and if you divide by 12, which is arrive at running balance, you get 135%. However, in this illustration from January to March, there looks to be a calculation error from the Provident Fund department because the running balance interest calculation does not match. So I have shown this in this statements that could be an error, because the illustration it shows 2,362 rupees as taxable interest, whereas actual calculation is 1,756. See, another important thing which you also should be remember is the moment the taxable amount and the non-taxable amount along with the interest gets calculated, then non-taxable account, the interest plus the 2.5 lakhs and the previous accumulation will be continuously be placed. That will be saved from the tax. And also the non-taxable account, which in this case on 2,362, 10% of tax is 236 rupees, and minusing that from 112,362 rupees, then the net of opening balance is 1,12,126 rupees gets carried forward to the next year so that it can be treated for taxable account. Of course, there is if you have a withdrawal in any year, then good news is that the Provident Fund Department first takes the taxable account amount and then comes to the non-taxable amount. That is the good news which you will have if you have a withdrawal for any purpose allowed under the Provident Fund and Miscellaneous Provisions Act 1952 and also EPF Scheme 1952. Therefore, you can see the possibility to withdraw when you have any appropriate reason to withdraw as per the provisions of the EPF scheme. This will reduce your tax burden. And of course, as I talked about earlier, this EPFO guideline is very exhaustive, and definitely I would suggest you to read it for more information and details. I will sign off at the moment, and if this video has made a difference to you, please do like, share and subscribe to the channel. And thank you for watching this video. And in case you have any doubts and clarifications, you know how to contact me. My email and mobile numbers are provided in the previous videos, and I will also continue to provide in case you have any doubts and clarifications. Until then, friends, see you soon in the next video.